Hi everyone, I'm Steve Levy with Ipsos Canada, and I'm pleased to welcome you all to the 7th webinar in our Path Forward program. Now, over the last 9 weeks or so, we've covered a bunch of different issues. Everything from the creative fight back last week to the subject of empathy, moving from empathy, if you like, to impact, which was a few weeks back, and the Chinese experience, which kicked off our program a while back. Now, all of these webinars are available. They've all been recorded, and they're all at our website. There's a few quick housekeeping matters just before we get started. The first is that while you will all remain in listen-only mode, you can ask questions by simply clicking on the question button. Time permitting, we will answer the questions at the end of the webinar. If we do run out of time, we'll get back to you with an email. Today's webinar will be recorded, and within 48 hours of the conclusion of this webinar, the recording will be posted to the site. Now, the Path Forward program is very much intended as a thought-sharing platform. It covers and has covered a number of different issues that should be relevant and pertinent to you and your organizations and the things that you're both facing. At Ipsos, we've been conducting a weekly COVID tracking study. We started it back in March. We've been running it in 13 countries around the world. I should tell you that despite the fact that the provinces are now looking at opening up their economies, just last week we found that 5 in 10 Canadians have seen an increase in mental health related issues. Now, while that's a frightening finding in and of itself, perhaps it's not so surprising when you think about the fact that 4 in 10 of us are worried about job loss. 3 in 10 of us are dipping into our savings, and 2 in 10 of us are borrowing money at this point in time. 20% of Canada is sinking from a financial perspective. This tracking program continues in place. If you have any interest in the plethora of issues that we cover, please do reach out to me at steve.levy@ipsos.com. Over the past 12 weeks or so, some of our clients have most certainly been challenged. Some have been in survival mode. Others have been assessing their circumstance. Some have been pivoting, while others have been fortunate. Their business has been going gangbusters, and they've been investing. For many of the clients that we work with in financial services, they've been pivoting. They've been trying to understand the new reality, and they've been starting to think about what next. Today, I'm pleased to introduce you to my colleague, and in fact my neighbor, Ray Kong. Ray has spent almost all of his career, in fact, in the financial services world, on the client side in marketing at TD Canada Trust, then at Sun Life, and for the past decade with us here at Ipsos. Today he's going to share some of his thoughts about the present and the future of money and financial services, all informed by much of the attitudinal and behavioral tracking work that we do, with a healthy dose, if you like, of interpretation and speculation. Ray, over to you. The cameras will now go off. Ray will cover his issues, and then you'll see us both again as we cover Q&A. Ray, over to you, as I said.
Good morning, or good afternoon, everyone. Hello. It is my absolute pleasure to spend some time with you today. I'm really happy to see the names on the attendee list of people with whom I haven't spoken in far too long. I welcome you, and I look forward to reaching out to you after today's session to set up a time to connect and to catch up. Some of you might remember the TV series The West Wing, which started in 1999. It was a show about a fictional White House president and staff and ran for 7 seasons to great critical acclaim. There was a story thread midway through the 4th season about the president's re-election campaign. The recurring story highlighted the differences between the 2 candidates, and that one of them lived in the world of 10-word answers, and the other encouraged people to think about the next 10 words and the 10 words after that, because sometimes You just can't convey that which is complex in 10 words. I think we live in a world of too many 10-word headlines. So in response, what I will try to do today is to go a little deeper into some financial services issues to provide some context, some food for thought, and hopefully some ideas as we all try to understand what might be in store over the next couple of months. But if you really want a summation of this webinar in 10 words, here they are. Accelerate capability to match new behavior. It's not going back. For many Canadians, this pandemic has always been more about economic health than physical health, both personally and for the country as a whole. We've been tracking a wide variety of metrics since the beginning of the pandemic. Here you can see that Canadians' concern about personal financial impact rose sharply in the first month of impact, and then it has been holding steady ever since. Concern about ability to keep up with bills slowly declined as the first stimulus payments hit, and that has risen slightly as the pandemic wears on, and economic reopening is happening slower and more gradually than some would like. Concerns about both those are higher than concerns about personal health in the population at large, which is the thick purple line at the bottom. The younger generations, Gen Z and millennials, have been particularly hard hit financially. It stands to reason as they generally have lower incomes and are less well and permanently employed, all a function of their stage of life and career. Significantly, more Gen Z and millennials tell us that they have either had to dip into their registered savings or have had to borrow money just to make ends meet than the rest of the population. Let's store that fact that they have been harder hit financially for a moment. When we look at Canadians' responses to a wide variety of attitudinal statements, both financial and in other categories, we found that there are 5 different mindsets that exist in the population today. For example, there are some Canadians who are clearly very anxious about now and the future. They are the most likely to say, I am concerned that I will lose all or part of my current source of income, or I am now being more mindful of how much I spend when I shop for food and beverages. There are those that are relatively blasé about the situation and are taking everything one day at a time. They're most likely to say, if I stick to my financial plan, I will be able to get through this economic downturn. Then there are those that are decidedly optimistic and see this downturn as a major opportunity to make money. They are most likely to say, the current downturn in the market will create investment opportunities for me. Okay, we thought this stands to reason. This latter group will be comprised of wealthier, older Canadians with both time and money to invest, and with the market low, they will be looking at this as a prime time to buy. A double check with some of you anecdotally confirmed that you are seeing people with this mindset in your customer bases. What surprised us as we looked for the next 10 words is that people with this mindset are younger than we first supposed, and that they include both millennials and Gen Z. In fact, a higher proportion of Gen Z and millennials agree with the statement, the current economic situation is an opportunity for me to invest and make money. Remember, we started out by sharing data on the disproportionate financial impact and greater than average concern among Gen Z and millennials on personal finances. This didn't make sense to us. Until we dug a little bit deeper and saw a companion uptick in interest in real estate, specifically primary residence. Then it made a bit more sense. But not just real estate, apparently also equities. The 10-word headlines reflect the skyrocketing online trading volumes, and we know that many of you in this space will corroborate that heightened level of activity. We've heard stories of financial advisors who are hiring because they can't keep up with the new demand. As an aside, we also know that many are really having trouble adapting to the new environment, but more on this a little bit later. E-Trade shared that 54% of Gen Z and millennials check their portfolio at least daily. Online trading platforms are seeing somewhere between a 35 and 50% year-on-year increase in logins from mobile devices. Granted, volume and transaction value are two very different things, and this is more about volume than value. But the point is that the next generations are seizing the opportunity to build wealth. And as their importance and wealth grows, the channels of interaction used to do so will look vastly different compared to the past. As Bob Dylan said for his generation, but is true for all generations, the times they are a-changing. Without a doubt, digital usage and engagement across the board, to no one's surprise, has gone up. Some say that we have leapt ahead 5 years in digital adoption and usage in the last 2 months. And in anticipation of this, or maybe in response to this, we know that many organizations, hopefully yours included, have accelerated the development of digital capabilities over the last several weeks to meet demand. The most common question that we are working with our clients on these days is which behaviors will stick and which will revert. There seem to be two schools of thought on the spectrum of what post-COVID behavior might be. One end of the spectrum has us all more or less returning to our pre-COVID behavior fairly quickly post-lockdown. Back to the malls, back to the branch, back to the office. The other end has us continuing with our newfound digital ways and seeing a rapid demise of bricks and mortar, retail malls, and bank branches as we knew them. The answer, which of course will only be revealed in the fullness of time, is reasonably somewhere in the middle. We think that there will be a few fundamental shifts and many incremental shifts. As a comparison, let's look at another formative event, 9/11. Post 9/11, we could argue that nothing really changed in airline travel at the fundamental level. Although volume took a long while to recover to pre-9/11 levels, we still flew on planes for business and for pleasure. But as we all know, there were lots of immediate and significant incremental changes in the experience. Security, personal items, and liquid restrictions, and rebooking protocols. And other incremental changes rolled out over subsequent years. Every adult needing a valid government-issued photo ID, body scanning technology, and in-flight baggage protocols. Over time, they added up to a significantly changed traveler experience, despite the fundamentals remaining the same. To apply some structure to understanding how things might change and what will change, we use a behavioral science approach. One of the models we use breaks down individuals' behavior into 5 influencing forces. Their motivation for the action, their ability and capability to do it, physical considerations in getting the action done, the decision-making process, and social and cultural norms. The acronym is MAPS, M-A-P-P-S. By understanding people's current state, the trade-offs that might exist between each of these forces, and the severity of each, we can better understand and influence the behavior. A change in one of these forces changes the whole decision-making process, and therefore an examination of those changes can be helpful in understanding whether a behavior is going to stick for the long term or not. Let's consider the physical dimension. When stores were shut, the options we had were simple. Shop online or do not shop. Our behavior changed in response to a change in the physical dimension. As we open, the physical circumstance changes again as safety protocols are implemented by store operators, and in fact will likely change 2 or 3 times in the next several months as location operators adapt to the acceptable risk tolerances of their customers. In response, behavior will change every time, but motivations will not. But here are the next 10 words. Let's compare expected behavior on non-grocery shopping versus physical bank branch visits by looking at some intention data. Canadians are telling us that their expected intention to keep banking online is higher than their intention to keep non-grocery shopping online. If we assume that both retail stores and bank branches would implement similar physical safety practices on reopening, what's the difference? The difference lies in the other parts of the behavior equation. Non-grocery shopping is motivated by three things: a need to fulfill a task, social interaction, and the desire to explore. A bank branch visit is generally only motivated by one thing: the need to complete a task. Most banking tasks can, to a greater or lesser extent, all be completed online, so there is less reason to risk a branch visit, no matter the protocols in place. The social interaction and exploration motivations of shopping are not as easily replaced online, so our expectation is that we will see a faster bounce back in mall traffic than bank branch traffic, if in fact bank branch traffic bounces back at all. That's a bit of a mouthful. Here's another take on the change in the physical dimension. I'm old enough to remember having to line up at my local bank branch on Friday afternoons to get enough cash from the teller to last the weekend. Before multi-branch banking, before extended hours, before ATMs and debit, to buy something required cash, and there was a physical exchange in making the purchase. I saw bills leave my hand and my wallet get thinner. Going back to our behavioral science model, the physical exchange, did I have enough cash in my pocket, was an important part of the act of purchasing. With the introduction and accelerated use of tap, we are losing, or maybe long ago lost, that influence on the decision. Arguably, Gen Z never had it, so money is only an abstract concept. This helps to explain the generational shift in importance from the physical in the model and the relative greater importance of the ability dimension, manifesting itself as an expectation of always on and instant gratification. Some are suggesting that Gen Z, as the least behaviorally impacted generation through this pandemic, should be the archetype for all post-COVID behavior. Let's go back to the potential flurry of first-time home buying activity and consider what might need to change in order to process that demand in the next few months. For lots of good reasons, many lending processes contain physical necessity. Legal documents and their authentication for lending purposes require original signatures. And conventional wisdom has it that branches remain the anchor for complex financial transactions and those requiring physical authentication. But if the dominant behavioral archetype for the post-COVID world is Gen Z, physical is just not the way things are done. And if you agree with our behavioral science reasoning that physical channels in banking are not going to be as relevant in the post-COVID future, more than before and more urgently than before, your systems and capacities better be built to manage these and every other financial services need as seamlessly and as easily as in the face-to-face world. Because if they are not, and your competitors are, you won't get a second chance. As an aside, there was a question submitted prior to the webinar asking about this dimension, specifically in agricultural lending. I will reach out to the asker, the questioner, after this, and I would be more than happy to explore that specific situation with you. Let's look at the next 10 words, however. Before COVID, we were working with our clients to understand and respond to a sure and steadily eroding trust in and engagement with advisors. COVID financial stress has accelerated and magnified the paradox that the Canadians who have the lowest financial confidence and who need financial advice the most are also the ones who don't want to pay for or trust advice from financial advisors, and they are the group with whom financial advisors generally find it least attractive to spend their time. We've already highlighted Gen Z and millennials, but also women of any generation index higher on many of these measures than the general population. There are signs in our data pointing to a greater openness for advice in the population rather than doing it alone. But the current advice model has built-in inhibitors to the provision of advice to them. What do we think is needed? An aggressive acceleration of the changes to the advice-giving model that were inching along pre-COVID. One of these is accessibility and language. Not so long ago, I sat with my 23-year-old daughter on an hour-long financial education session with a financial advisor. Now, I'm pretty financially literate, and I understood maybe half of what the advisor was saying. My daughter, she said less than 10%. The content was all about investments, not budgeting, not debt management, not financial planning, making investments, and not even simple investments at that. It was pretty complex. The financial advisor was focused on investment advice, not financial advice. Coming out of COVID, we need to accelerate the morphing of advising services to be holistic, not investment advice, financial advice. Arguably, with the financial stressors and the need to find ways to pay back stimulus money over the course of decades, coming out of COVID, we need to be helping Canadians manage their money now, not simply invest for the future. Oops, I'm sorry. COVID has laid the groundwork for and enabled digital advisor-client relationships via text chat, video calls, and so on. It's not just the opportunistically minded Gen Z and millennials who will continue to engage this way in the future. COVID has created the situation where the majority of Canadians have done something digital for the first time. We have discovered that we can fulfill financial tasks without physically engaging with someone and have complex and in-depth conversations without being across a physical desk. We mentioned earlier that we know some financial advisors are, in our clients' words, having difficulty adapting to the new environment. They are clamoring to be allowed to connect back with their clients face-to-face. But thinking about it from a client's point of view and going back to our behavioral science model and the physical dimension of behavior, why would clients get in their car, go to an office, get in an elevator or go to a branch to see someone face-to-face when they could just hop onto Zoom and have the same conversation? We need to be blunt. Whose need is it to meet face-to-face, the clients or the advisors, or is it driven by regulations? But here's another 10 words. Historically, the receptivity of women to technologically based service solutions and advice has been lower than that of males, and particularly lower among Boomer and Gen X women. On our technology adoption scale, a greater proportion of them are what we call tech skeptics. Given this historical technological skepticism among Boomer and Gen X women, and that bank branches have been an integral part of many advice delivery strategies, doubling down on face-to-face advice through a physical branch network would be a natural solution for the future. But on almost every dimension that we measure, women are more concerned about the risk of physical reopening than men. And if we think that the end of the branch is nigh because COVID has taught us how to connect digitally, then Houston, we have a problem. This complexity is why we think a total rethink is needed. How will the changed physical circumstances, the perceived risks, and the digital skepticism of women affect their behavior going forward? We know that the pandemic has the potential to disrupt physical tasks and behavior, but what we're trying to show is that the issues are far more complex and deep-rooted, and that incremental changes to the system, like more hand sanitizer in branches, will not be adequate in the long run in the post-COVID world. The challenge ahead then is this. How do we reinvent to meet changing behaviors, needs, and how customers interact with banks and other financial institutions? One way is to accelerate the redefinition of the whole value proposition. Much of the current pricing model in financial services is about fee for service or fee as punishment rather than fee for value and reward. The current value proposition is in many ways too intangible. Pay your fees and your money is safe. You get access to the payment system and your money will grow faster because of our advice. By the way, cost us too much to serve you and we'll penalize you. This has hindered the emotional loyalty long sought after by the industry. Thankfully, the trajectory within some financial services organization in response to digitization, increasing competition from non-traditional players, open banking enablement, and in the provision of advice has been to create fee streams that provide ecosystem value, not punishment. Heretofore more the domain of credit card rewards programs, our suggestion is that the value proposition in the post-COVID world needs to accelerate beyond credit card rewards to embrace a broader definition of health, financial, emotional, mental, and physical health, and to provide enough value for participation in the ecosystem to be able to charge for it. Traditional bricks and mortar retailers and malls are pivoting to create digital malls. They are seeking to increase relevancy, relationships, and habits through partner ecosystems. Financial services has started the same and needs to accelerate. Ipsos is in the business of understanding perceptions, sentiment, and behavior, and their impact on our clients' businesses. The forces of Gen Z and women on technology development, adoption, and the fundamental shifts in the value propositions are converging with the physical and non-physical business of financial services. In the post-COVID, branchless, less trusting, more digital world, financial services organizations are going to have to double down to find new and innovative ways of providing value to all clients. We believe that the future meaning of money is value exchange, not currency exchange. Fee for value will provide positivity in seamless access, convenience, personalization, and meaningful rewards. And for sure, we can all use some positivity going forward. We started with our own 10-word headline of the situation as we see it going forward. Accelerate capability to match new behavior. It's not going back. But we also hope that we've shown how it's more complex than that. What I walked through today skimmed the surface of our knowledge. For our clients, we dig deeper and we work with them to drive and evaluate their decisions. We'd love to talk to you about the challenges you are facing and to work with you to plan forward and to help you master the next 10 words and the 10 words after that. Thanks for listening.
Thank you, Ray. And for the 197 of you who are remaining, please don't go away yet. We do have a few questions. Some of them are interesting. Some of them are provocative. I know that if there was one takeaway I had from today, it would be this notion of it's more than investment advice, it's financial advice. So there are a few questions. Ray, you're back on the screen as well. For some of the questions, I'm going to read them. For others, I'm going to paraphrase. The first question is about the fact that for all 5 major banks in this country, a good portion of their network closed, somewhere between 20 and 30%. The question is, do you think that when the banks all come back online, so to speak, they'll reopen all of the branches that were closed?
I think in the short term they may, but in the medium term they will not. I think that banks need to challenge themselves to think about the ecosystem that we briefly talked on and talked about whether retail space, bank branch space is, as the way we knew it before, is the way that it should be in the future. And if we think about an ecosystem of shared motivations and shared physical space, I might be tempted to think about post offices combined with banks, combined with Staples stores to share physical space to provide the same services, but in a different way than before.
But is that a function of the COVID scenario, or is that something that was happening before and that COVID simply accelerates it?
I think COVID simply accelerates it. You know, we've all heard the stories about businesses and real estate becoming less relevant than before, and if, you know, real estate is a huge cost, if there's a way of sharing and if there's a way of providing ecosystem value to consumers, then I think that we need to be exploring that.
Got it. So like me, you know, you've been around through 3 recessions and or meltdowns, one in the 80s, one in the 90s, and then there was 9/11. Again, I'm going to read this one. Is the extent of change or lack of change that we might see post-COVID going to be any different from what we saw in the 80s, 90s, and after 9/11?
I think yes. The theory of evolution got replaced by the theory of punctualism some years ago, which says that change does not actually happen in slow and steady spurts, but in fact it happens in very rapid ways in response to big burning platforms. And if there was ever a definition of big burning platform, I would say that we have big burning platform now. So to imagine that we go back to the way things were before, I think is a mistake.
You talked a little bit about the generations earlier in your commentary, and I'm not sure if the person asking this question is referring to that there, but the question is, do you think that coming out of COVID, there are going to be winners and losers?
Unfortunately, I think yes. We already saw before all of this happened a concentration of wealth in this country and in many other countries, and I think the number was something like 2% of the Canadian population controls 74% of the wealth. And with this situation, I think that's just going to exacerbate the issue. It's going to widen the gap between rich and poor. The definition and the demographics of who are wealthy and who are not may change slightly, but for sure there will be winners and losers. And we will look to our public policies and our government and our large institutions to help us through that, I think.
There's another question I'm going to read to you. How do you see future appetite among established players for emerging technologies in the space, fintech here, and on which services will future investment be focused?
I think that one of the interesting things about the last 2 months has been that many of the things that were happening pre-COVID have just been accelerated, and that is the digitization of banking, the movement of banking to ecosystems as opposed to payment systems like open banking. I do think that the appetite continues to be there among the large established financial institutions. It's really difficult to disrupt yourself, though, as lots of business cases will show. And the question actually will be whether or not they can disrupt themselves or want to disrupt themselves, whether they can disrupt themselves as opposed to whether or not they want to.
And on that note, thank you very much, Ray, for today. Our next webinar is going to be on June 6th, when Kelly Becker will be talking to the issue of innovation in unprecedented times. Then on June 22, Nally Haig will be covering the subject of understanding the emerging consumer behavior. Please do watch out for invitations to these webinars, and we look forward to seeing you soon. Please do stay safe. Thank you for joining us today.
Thanks, everyone.